Please come to the disclosure part now. The last part of this wonderful standard. In the financial statement, major component of tax expense or income such as current tax, prior period tax, deferred tax, reversal of deferred tax, previously unrecognized current tax or deferred tax now recognized. So all these items you will show in tax expense. Reversal of deferred tax, previously unrecognized current or deferred tax will be shown. Then aggregate amount of current and deferred tax on items that are credited or charged to equity. So in case if you have charged directly to equity, amount of current tax and deferred tax that will be disclosed. Then amount of income tax relating to each component of OCI in the notes to account. In the OCI you can show net of tax, but the tax expense will be shown in the notes to account. Amount and date of expiry, if any, for deferred tax asset. For example, if DTA is created on carry forward loss, and the loss can be carried forward for 8 years. That means you know that in 8 years if I do not have sufficient profit, this DTA would lapse. So that you have to disclose amount and date of expiry, if any, for deferred tax asset. And then disclose unused tax losses and unused tax credit for which no DTA is recognized. That also disclose. That company has not recognized DTA for the following unused tax losses. Deferred tax relating to business combination, that you disclose. We have learned business combination chapter, and in this chapter also we had gone into sufficient detail for disclosures. For this business combination, DTA, DTL on goodwill not to be recognized. In case of DTA on goodwill, how to do calculation, that also I have told you. Is it right? Next paragraph. Deferred tax associated with investment in subsidiary, branch, associate, interest in joint venture, not recognized, that you disclose. This portion actually we have not discussed much in detail. Deferred tax related to these group entities. Then income tax in respect of dividend distribution to shareholder. Now, are you not feeling that the standard is going beyond the scope by asking you to disclose this item? This standard is on income tax, and what they are asking you to disclose, the income tax in respect of dividend distribution to shareholder. Supporting evidence for recognizing DTA on the basis of future taxable profit. Do you remember this paragraph? If you are recognizing DTA, when we can recognize DTA? When either there is DTL or there is future taxable profit. So in case if you are recognizing DTA on the basis of assumption of future taxable profit, then you have to disclose the evidence. So you have to say that our company has got a order from a customer. It's a big order. On the fulfillment of that order, we will make enough profit. You can say our company has got the patent of a important drug, and now we can make huge amount of profit. Our company has got an oil field discovered. Okay. Now we can make huge amount of profit. So on what basis you have decided to recognize DTA, disclose. An additional disclosure is requirement. Requirement relates to numerical disclosure numerical reconciliation statement. So this standard wants one more thing. You have to give a numerical reconciliation statement being presented to explain the income tax expense and accounting profit in either of the following form. Reconciliation can be of the amount, that is reconciliation of amount commencing with accounting profit. So you will take PBT multiplied by tax rate. So you will get, this is what your tax expense should be, and you have to compare with actual tax expense. Actual tax expense means current tax plus deferred tax that you have recognized. Theoretically, it should tally. If it doesn't tally, that means there is a reason for some difference. The reason for the difference could be that suppose an expense is permanently disallowed. So this will increase your current tax. Okay, so therefore this two figure may not match. So this is one example. So you have to identify due to which items there is a difference between this figure and this figure, and that will come in the reconciliation. Or another example could be PBT into tax rate 30%. But it is possible some item of income may be taxed at a higher rate. Some item may be taxed at a lower rate. So that also you can write. In the profit and loss, you might have included income which is exempt from taxation. Okay. But that is not treated as an income for taxation purpose. So that will again give rise to differences. So all such items, income permanently disallowed, income not considered for income tax purpose, difference in tax rate, all this you have to write here and reconcile. So you may get a question also on this point. Okay. They may give you a question and then you have to reconcile. Reconciliation can be based on amount. This is an amount reconciliation. Or reconciliation can be based on effective tax rate and applicable tax rate. So applicable tax rate 30%. But your tax expense as a percentage of income comes to 35% or 29%. Then again you have to identify why the tax expense is more than the tax rate. Okay, so I'm going to make you write one example in the notebook. Write example on reconciliation. Example on reconciliation. An entity has made an accounting profit of rupees 1 lakh. An entity has made an accounting profit of rupees 1 lakh. The tax rate is 30%. The tax rate is 30%. In computing the accounting profit, a penalty of rupees 10,000 has been considered, which is not tax deductible. Calculate current tax and show reconciliation. So this is a simple example. This can be a part of a bigger question also. Now write the answer. In this case, In this case, the taxable profits are rupees 1,10,000. In this case, the taxable profits are rupees 1,10,000. Why 1,10,000? 1 lakh is your PBT, 10,000 expense disallowed, which is not a tax deductible expenditure. So plus 10,000. So you will get 1,10,000 into 30%. So therefore tax expense is 33,000. Written. Two types of disclosures are as under. The two types of disclosures are as under. The two types of disclosures are as under. Now write down. First write down current tax. Or you want to ignore this because you already written this. Ignore. Just understand quickly. PBT 1 lakh. Same note you have written. 10,000 penalty disallowed. Taxable income and current tax. What about the deferred tax? This item which has been disallowed, its a tax base will also be equal to 10,000. Permanent disallowance. So for permanent disallowance, we do not create deferred tax. Or in the language of this standard, IAS 12, this also will have the same tax base. Okay. So since these have same tax base, there is no deferred tax implication. Now write down reconciliation, amount reconciliation. Amount reconciliation write down. Only one item is there because of which there is a difference. So now write down accounting profit 1 lakh. And what is your tax rate? 30%. So tax at the applicable tax rate of 30%. Tax at the applicable tax rate of 30%. $30,000. Then write down tax effect of expenses. Tax effect of expenses that are not deductible in determining taxable profit. That are not deductible in determining taxable profit. Penalties write down 3,000. So this is a reconciling item. And therefore tax expense 33,000. So this is an amount reconciliation. By applying the formula PBT into tax rate, we are getting 30,000. But tax expense you are showing is 33,000. Why there is a difference of 3,000? It is because of this item, penalty. Okay, now write down rate reconciliation. Rate reconciliation. Under rate reconciliation, write down applicable tax rate applicable tax rate 30%. This is your applicable tax rate. And what is my effective tax rate? What is my effective tax rate? My effective tax rate is, see on the screen, 33,000 we have paid for 1 lakh rupees income. So my effective tax rate I am actually paying is 33 divided by 1 lakh 33%. So why there is a difference of 3% here? Because this penalty was not allowed. So because this penalty was not allowed, I had to pay 3,000 more in terms of percentage. I had to pay 3,000 upon 1 lakh into 100. That is 3% more. That is 3% more. This is rate reconciliation, 33%. One more example, write down. Example number 2. This time I will give you two adjustments. In 2022, an entity has accounting profit in its own jurisdiction. An entity has accounting profit in its own jurisdiction, that is country A, of rupees 1500. Of rupees 1500. In bracket write 2021, that is year 2021, rupees 2000. Rupees 2000. And in country B, of rupees 1500. And in country B of rupees 1500. In bracket write year 2021, rupees 500. Rupees 500. The tax rate is 30% in country A. Tax rate is 30% in country A. And 20% in country B. And 20% in country B. In country A, an expense of rupees 100 in bracket year 2021 rupees 200 are not deductible for tax purpose. Are not deductible for tax purpose. In bracket write permanent disallowance. Permanent disallowance. Permanent disallowance. Calculate current tax and show reconciliation. Calculate current tax and show reconciliation. So this time there are two reasons why your tax as per accounting profit will not match with your total tax expense. One, this expense disallowed. Second, lower tax rate in country B. Is it right? First you calculate current tax. Basic calculation current tax. Right hand side two columns, domestic, foreign. Then write down 2022, 2021, 2022, 2021. Point number A, PBT 1500, 2000, 1500, 500. Then write down point B, expenses that are not deductible for tax purpose. Expenses that are not deductible for tax purpose. Assuming permanent disallowance. Assuming permanent disallowance. It is written in the question also. So don't write 100, 200. Then write down taxable income. 1600, 2200, 1500, 500. Tax rate 30%, 30%, 20%, 20%. Current tax 480, 660, 300, 200. Sorry, 300, 100. So what is my current tax for the year 2022? 480 and 300 foreign, 780 current tax for current year. And what is current tax for 2021? 660 plus 100, 760. Okay. What about deferred tax? Again, this is a permanent disallowance. So its tax base will be equal to carrying amount. No difference. No difference for permanent disallowance. So in this example also, deferred tax is 0. Now write down reconciliation. 2022, 2021. Point number A, accounting profit. Accounting profit, add both the income, local income and foreign income. Check, is it 3000 and 2500? Then what is your tax at domestic rate of 30%? 900 and 750. This is what my tax expense should be. This is what my tax expense should be. But what is your tax expense in the first year? 780. Second year? 760. Oh, it's not matching. Two reasons we have identified. One, write down. Tax effect of expense that are not deductible for tax purpose. Tax effect of expense that are not deductible for tax purpose. That is 100 into 30%, comma, 200 into 30%. 30, 60. Now write down effect of lower tax rate in country B. One more item. This disallowance has increased my tax liability, okay? But there is a benefit also. In country B, there is lower tax. So effect of lower tax rate in country B. First year, what is the country B income? 1500 into 10%. 150. Second year, what is the income? 500 into 10%. 50. So this 50 you write in bracket. 150 write in bracket. Now if you see 900 plus 30 minus 150. So tax expense 780. Tax expense 760. Is it matching now? Now what I'll do, I will write one more question below this. Assume that disallowance is temporary. Assume that this allowance is temporary. What is the meaning of disallowance is temporary? Let us say this is a bonus payable to staff which you have charged in P&L account, but that bonus was not paid. Bonus was not paid. So it will be paid in the subsequent year now. So this year it will be disallowed, but in subsequent year it will be allowed. So this time there is a tax base of that liability. Tax base of the liability relating to expenses carrying amount minus the amount that will be deductible for tax purpose in future period. Tax carrying amount minus the amount that will be deductible in future period. So write down first heading step 1, calculation of tax base and deferred tax. Have you written case 2? Calculation of tax base and deferred tax. Now first you write down CA. What is CA? Carrying amount 300 and 200. Let us assume this is something like bonus payable which is allowed on cash basis. So in first year 200 was disallowed. Nothing is given in the question that this 200 was paid in the subsequent year. Is it right? So we will assume till the end of 2022 also this bonus is not paid. So my total carrying amount of that liability will become how much now? 300, na? 100 plus 200. Let me see the original question. How much was disallowance? 100 and 200. So 200 is opening balance plus 100 in this year also. So this is the carrying amount of liability. So the liability will become now 300. Why 300? Write in bracket 200 opening balance plus 100 carrying amount of liability in SOFP. You write in bracket assume 200 has not been paid. Because you assume 200 has been paid, your current tax calculation I will have to revise. Is it right? So unnecessary will not go to that working note again. So now write down tax base. Tax base will be 0. Still 0 because you have paid nothing. Formula for tax base is carrying amount minus amount deductible in future. So first year 200 minus 200. Entire 200 will be deducted in future. 0. 300 minus 300. Entire 300 will be deducted whenever you pay it. So 0. So now this time we'll have a DTD. Deferred, deductible temporary difference. Why deductible? In case of liability, if tax base is lower than carrying amount. In case of a liability, when tax base is lower than carrying amount, it gives rise to DTD. 300, 200. Therefore, DTA to be shown in SOFP. What is the rate of tax? 30%. This is the SOFP figure. 90 and 60. What is amount to be shown in P&L account? You will deduct the opening balance. Point number E. Opening balance 60, 0. So current year P&L account you will recognize 30, not 90. 90 is balance sheet figure. Opening balance already have 60. So in the last so many questions you have learned, we need to pass entry for the difference between opening and closing balance. So 30 will go to P&L account, 60 will go to P&L account. And how much is my current tax you have calculated? Add current tax. Do you remember current tax? Go to that earlier working note. Give me the answer. Current tax 780 and 760. So if there is a temporary disallowance, my tax expense will be tax expense in the profit and loss will be, you add these two figures F plus G, 810, and this is how much? 830, 820. Okay. And what is your tax as per the accounting figure? How much it should be as per account record? 900 and 750. So 900 and 810. How much is the difference? 90. Why 90 difference is there? 10% of foreign income. How much is foreign income in the current year? Is it 900? 1000? 1500. And previous year, how much was the? Wait a minute. There is a small calculation error here. This is your deferred tax. This is deferred tax asset. So it should be negative. That is why I'm wondering how it has happened. So this is 750 and this is now you see the difference 150 is 10% of 1500. In second year, how much is the difference between accounting and total tax expense? 50. Is it matching with the 500 into 10%? Yes. So you just make a note here, credit to P&L account. This is DTA. So entry will be DTA account debit to P&L account. And current tax entry is debit to P&L account. So the net effect is 750 and 760. Okay, so now write down reconciliation. $2022, 2021. Now tell me PBT total, both local income and foreign income. 3000 and 2000. Okay. Tax at the rate of 30%. 900, 750. Less lower tax rate in foreign country. Less lower tax rate in foreign country. 10% into 1500. 10% into 500. So 150, 50. Therefore, tax expense 750 and 700. In case if tax expense include deferred tax also, you have learned now how to do the adjustment. This chapter is over.